Good afternoon. I'm Mark Waters, the co-founder and CCO of Axe Trading. I'm honored to introduce today's panel discussion on technology and automation in fixed income. Fixed income is a diverse asset class with varying degrees of automation. We see this in the highly liquid and very automated US Treasury markets, all the way through to the still very manual, illiquid bond market, derivatives, and even repo and primary markets. The opportunities for automation are extensive, but unless it's handled correctly, the industry won't reap the full benefits. Fixed income trading is still, relatively speaking, a very people-intensive business, and care needs to be taken not to alienate the people who sustain it in the race for automation. The key building block of automation is data. Fixed income liquidity and pricing data comes in many forms, and to complicate further, it's usually specific to the counterparty, the size, and the direction of the trade. This poses challenges to providing an accurate picture of the market upon which automation can be built. The further challenge of capturing, normalizing, and retaining quality transactional data across all workflows adds complexity. In the quest for automation, having the right technology or the right technology partner is key to success. Openness and interoperability of technology is also important, and has already become commonplace in other asset classes. This isn't yet the case in fixed income though. Legacy technology providers have built substantial businesses within their walled gardens, resulting in automation that extends only as far as their offering and little further. This too has to change. We're seeing a new generation of technology providers whose ethos and business is built around openness and interoperability. Widespread use of APIs and adoption of common standards for interoperability, such as Fix Orchestra, is helping automation to develop. We see other initiatives, such as ISDA's CDM, gaining traction for the same reason. AI, or artificial intelligence, is another interesting phenomenon. Fixed income markets are exploring its application, from trade matching to automated market making. However, when it comes to trading automation, predictability of outcomes is a key factor in ensuring the marketplace maintains trust and confidence. For this reason, firms like Axe Trading have emphasized the development of configurable, performant, rules-based automation over an AI-led approach, which by its nature embeds less predictability. After all, if one's answering to a regulator, one needs to be able to fully account for the actions of the firm. In the drive to automate, we also need to build in the tools to ensure proper control and regulatory compliance are maintained. Finally, let's not forget that the cost of automation will always ultimately be weighed against its benefits. With that, I'd like to hand over to our moderator Matthew and our panelists. I look forward to what promises to be a very interesting and exciting debate. Thank you.
So, we're now moving from equities to fixed income, and we have a panel on trading and automation in fixed income. We have a brilliant panel set up, and it's unfortunately you're going to have me as your moderator. But we have Mark Waters from Axe Trading, who's the co-founder and the chief commercial officer, to introduce this panel. We have our panelists, we have our moderator, and we do have a bunch of panelists who are definitely not backward in coming forward with their views. So, if I may, if you could introduce yourselves, Ravi, starting at the top, and we'll go across to you, sir. Firstly, thank you for jumping in. Literally, we were talking at 5 o'clock last night. So, Ravi, you know, absolute star, mate. So, thanks a lot. But if you could introduce yourself, that'd be brilliant.
Yeah, sure. And no problem stepping in, mate. So my name's Ravi Sawney. I work at Bloomberg, and I look after our buy-side trading automation and analytics business.
Mr. Grady probably doesn't need much of an introduction, but please go for it, sir.
Thank you, Matt. So Stephen Grady, I work at IHS Market, and I'm responsible for market structure and strategy.
And Connie.
Good afternoon. Konstantinos Antoniadis. I run the fixed income business globally at Liquidity.
Brian.
Yeah, hi, Matt. Thanks for having me. Byron Cooper Fogarty. I'm the interim CEO at Neptune, which is all about distributing access from dealers to buy-side clients.
And last but not least, Mr. Falco.
Afternoon, Matt. Andy Falco. I'm the global head of fixed income and FX trading at Fidelity.
All right, thanks, guys. So I think probably we've got a Slido question that we talked about previously, which we've actually gone live with. So guys, log in, slido.com, hashtag FixEMEA2020. And what we really want to make sure as well is also keep questions coming in live if you've got them, because I know these guys aren't any shrieking violets, so we could definitely they'll answer the questions which we put to them. So I think the question out there is, did you turn off your automated trading strategies over the last crisis? We have to look at COVID, we have to look at what's going on. And let's just define this properly in terms of when I mean that is buy side responding to automated tools, and also brokers from a automated quoting perspective. So Andy, you first, sir.
So obviously as we started through March in Europe, at least, obviously for us, it really began in January. We obviously started to observe, obviously, as everyone is aware of, obviously the velocity and the speed, obviously, of the price destruction, and obviously sort of then begin to obviously sort of unpick the automation that we've put into place. So through March and April, we use a number of venue systems like AIEX and obviously Market Access in their offering. And those were largely turned off. We didn't have the confidence in the price. The markets were moving too fast. Price was not refreshing quickly enough, and a lot of the algos that are pricing some of the smaller transactions weren't really basically sort of being able to respond.
And do you think that was actually a technical problem or just a pullback of liquidity from the market due to the volatility?
I think both.
Okay, interesting. Ravi, Bloomberg has automated solutions in terms of the sort of the things that Andy was talking about. What did you observe?
Yeah, so I think, so my response, I guess, is based on what we've seen with, the few hundred clients we got live on our rule builder platform for equities and for OTC automation. So on the equity listed side, we didn't see much of a pullback, if any. People were carrying on and keeping the rules live. But there definitely was a pullback on the OTC side. So especially within fixed income, we saw clients just suspend rules, especially during, a couple of weeks into March. Around, I think, March the 20th is when we kind of had the low point in terms of active rules. And then from that, we saw an interesting kind of diversion between those clients that kind of more experienced and have been doing automation for longer, just kind of quickly start ramping up the rules, turning them back on. A lot of them took the opportunity to kind of go into their rules and perhaps kind of adjust some of the tolerances as well, to kind of factor in the lack of liquidity or the different paradigm they're currently operating in. Whereas, the different cohort, or perhaps a bit newer to automation, took a bit longer to actually turn back on, and perhaps use things like one click as well to put like a speed bump in the automation process. So definitely some interesting dynamics, but I think we've kind of gone on now and we're kind of at full strength.
And going back to Andy's point, he thinks it's maybe a bit of a challenge in terms of the tech and also potentially the liquidity. We all know fixed income's principally driven market. From the tech side and the data quality side, did you see any sort of change in terms of data quality or the amount of data that you're seeing going through your platform from the analytics side of things?
Yeah, there's not a lot. Liquidity we can't do much about from the automation side, right? The automation engine sits on top of the trading venues. There was, on the data side, like I said, I think there was a period where clients went back into their rules. And in fact, we encouraged it as well, right? The important thing with automation is that you configure the rules, but you kind of got to go back and look at the rules again and see, does it make sense? Am I optimizing the rules for the current market conditions? So, in some cases, if they wanted X number of dealers to price back on an RFQ and they weren't getting it because the liquidity wasn't there, so then they can kind of take a view and actually kind of step down and ask for less prices. Or in some cases they can use kind of a co-pilot mode where the automation engine would try it first, and if it failed, it then route it back to the trader. So we saw some of those dynamics play out.
I think that's a really interesting point on the liquidity side of things, because on the first panel we had Commissioner Benham from the CFTC talking about the Treasury market in the US, which obviously has a massive amount of automation. Andy, what did you see in terms of liquidity there and how that played out?
Absolutely. The Treasury market for us was one of the main problems that we had, whereby obviously again markets moving so fast. We've always believed that we can trade treasuries electronically. We began to question that, and needed to basically sort of go to slightly a more tailored mode of execution. Some of that requiring voice, some of that with less dealers involved. But again, it's been well flagged as to some of the problems that the Treasury markets have faced. And I think, as a product of that, we have to question and look at each trade and assess that on its own merits. And where we felt that the prices were reflective of the market and we could execute, then we would obviously use a venue. And if at that time markets were too choppy, or the prices were not based sort of reflective of where we felt the pricing were versus the future, then we would adjust.
So I mean that's an interesting point.
So that point that Ravi makes around the rule builder, that's a decision that you have to make real time. So yes, you can relook at the rules that you input into your automation, whether it be rule builder or any other venue product. Obviously, Tradebug Market Access is not on this panel, so I thought I'd better at least plug their products as well. But ultimately, you have to look to see what is right at the time, and speed, the velocity, the ferocity of the actual sort of market. If you're fiddling around with the rule builder, you may have already missed the trade that you're looking to put on.
Good point. So basically, in summary there, we're looking at a movement away from small trades and potentially even an aggregation and trying to source that block. Byron, from your perspective, obviously taking all the axes which are coming across your network, what did you see anything notably or anything that can come from that?
Yeah, definitely. I mean, the amount of data that would normally flow through Neptune in terms of the axes during the toughest periods of March and April, there was definitely a reduction. There's no doubt about that, and it goes without saying that that the markets were somewhat one-sided as well. And I'm sure Andy would bear that out in terms of his experiences as well. I mean, what we found is, regardless of that, I mean, and certainly there was a lot of publicity around, how much people were doing electronically, etc. But what often didn't come out, and certainly the feedback from most of our clients was, in reality, yes, they were doing a lot more electronically, but it was a smaller percentage of what they were doing overall. And ultimately, what we found, or certainly a lot of the feedback, and naturally we're talking to people who use axes to a large degree anyway, was that sort of pre-trade data became increasingly important to them. Now, was the data quality 100%? It's a fast market, it's a difficult market. So again, your feedback from the clients is that's an area that they would have liked to have seen improved, shall we say.
So that's an action item for us in terms of the fixed community to maybe look at that data quality. Connie, from your perspective, LiquidNet as a different sort of liquidity venue that which we generally see in terms of buy side to buy side, and also broker coming in as well. What did you guys see over the sort of the crisis period?
So I would say that our experience was very different than what was discussed in the last few minutes, and we saw a significant increase in both volumes and liquidity. So our volumes doubled. Effectively, if you were to compare the, let's say, first 7 weeks of the year, and then the next 10 weeks of the year, since COVID started, our volumes doubled. The amount of buy-side liquidity we had in our pool was up about 50%. And that is down to the fact that at that time, liquidity from the traditional sell-side firms dried up. And we saw more and more clients looking to find liquidity in what I call natural pools of liquidity, like LiquidNet. This is also where automation helped. And one of the protocols that really worked very well during COVID is something that allows you to go back in time and engage someone that had the opposite to a particular order the last few days. And at a time of liquidity stress, protocols like that can help a buyer find the one seller in the market, or the other way around, become increasingly useful. And that's why, again, what we saw was a very different experience, whereby trade sizes got bigger, negotiations got shorter, actually, and the amount of liquidity and volume that both the buy side and the sell side was engaging in LiquidNet increased. Thanks, Connie.
And Stephen, I mean, it wouldn't be a fixed income panel if we weren't talking about the primary market as well. And we had record issuances. I mean, how did that stack up?
Yeah, it's interesting because this has been a theme that's been ongoing for at least the last sort of 10 years, this balance between primary and secondary sort of shifting, and an increase in issuance occurring. Now, a lot of the issuance that was occurring was really defensive in nature, of course. But what's interesting about that is that if you think about how much more difficult secondary markets are getting and are in those sorts of circumstances, then having sort of tools to offset that and use technology to sort of offset that becomes a sort of an enhancer or a facilitator. So whilst we saw a big increase in kind of marquee issuance and total issuance as well, what was also interesting is people were leveraging the technology, not least of which, if you think of the task that the buy side is trying to grapple with, transmitting orders and receiving subscriptions back and what have you, is a lower sort of value task than going out to search for liquidity in a market that's becoming increasingly fractured, and when the traditional sources of it are evaporating either temporarily or in a sort of more secular sort of fashion. So that's one aspect of it, I think, that sort of often gets overlooked, is that we think of technology and automation as taking sort of something away, but I think it's really sort of enhancing in lots of ways and enhancing productivity, sort of moving people up the value chain or the contribution chain. That's one part of it. I think the other bit that perhaps gets sort of overlooked in the desire to look at sort of automation is the integration of sort of different tools. And obviously Mark is and Axe Trading are one of the facilitators of that, but there's obviously lots of people sort of playing in that space, trying to plug different tools together that are enhancing either contribution or insight, or giving you some sort of sense of being able to automate or improve your productivity in some fashion. I think that's there's a lot of sort of knee-jerk reaction that can be a little bit defensive around some of these developments, but I think a lot of it is really, if you start from the result, that if you ask people, what would you do with an extra 30 minutes in your day, they usually will come up with very good answers. And so Andy's sort of smiling there. I'm sure that he could do with an extra 30 minutes or hour in his day, and could contribute in an even more meaningful way than he is at the moment.
And I think that's a really good point, right? So let's go back to the buy side on this, and we've probably done a disservice here, right? Because we've jumped straight into the panel. We've been talking about COVID. We haven't actually really defined what we're looking at in terms of automation. So to the end user, Andy, what do you define, and where does the automation process start and stop, and where are your issues?
I'll sort of pick up from where Stephen started with the new issues sort of space, and there are two sides to that. Obviously, you have the external sort of development or creation of the security. There's your internal process as well, and I think what we found obviously through March, April, and May, with the issuance levels sort of I think March was 260 bill, April 290. You're talking about record monthly issuance, and the amount of time spent at the desk corralling to a degree, obviously different portfolio managers, engaging with analysts. We've decided to sort of work on an internal portal for that, to make the process less like herding cats, slightly more refined, more efficient. And then I think from the external standpoint, there are a number of obviously initiatives that have been, some started a few years back. Obviously, others on this panel can talk to their offering to bring automation to the new issue market, which would be to a benefit to anyone on the buy side, where you can streamline this process. So I think we're very keen to look at our own in-house workflows. I think you need to kind of make sure that your own data stack is where it needs to be, but also the engagement piece is critically important. And then externally, we want to be in a position to be able to engage with vendor solutions to make this process more streamlined. Thinking about automation across my teams, we're not looking to replace. We're just looking to adjust any processes that can be done differently. So if that refines what a trader can do at Fidelity, that will be looked at, and we'll look to enhance that. We want to automate aspects that are additive to the trader, and to Stephen's point, giving people more time to engage with PMs, work with our credit team, will give a better outcome to the investor. So automation isn't for us around sort of removing the individual from the process. It's more around giving each team the ability to do their roles more effectively, or as they would if they were doing it themselves.
Cool. And I think I just want to recap on one of the answers I've just got back in from Slido, which was our first question we kicked off before we get into the next one. But was how much do you switch off? And it was sort of the answer came out of that was 57% yes switched off, but 43% said they didn't, which I think is quite an interesting outcome in terms of where that's coming from. So I mean, I think you hit an interesting point there. So if we're looking at automation, we need to define this into two steps. We need to look at your internal systems, your internal data, make sure that that's up to scratch and look yourself in the mirror, and then expand externally to actually see what happens. And that is across the whole value chain in terms of primary and secondary. And it's not just jumping into the secondary market. So what I'd like to do is also launch our next Slido question. So if you're not responding, log into slido.com, #FixEMEA2020. And we'll launch the next question, which is, do you plan to increase automation on your fixed income desk over the next 12 months? And I will make that with the delights of technology, hopefully live. Done. So everyone can feed in, so we can see how that comes together. Sort of moving on from that, I think I've got 50-50 already, so in terms of yes and some coming in. But I mean, moving on from that, we're looking at this in terms of the overall trade life cycle. Ravi, if we're looking at internal data, we're looking at you guys putting systems in place and to enable that automation. How are you seeing that? And I think one of our biggest bugbears, all of us on this panel, I'm sure, is you're dumping equities into the equities infrastructure into the fixed income market. How is there a case of that, or is it a bit of change in terms of actually making sure that we build it, which is focused towards fixed income?
Yeah, I think it's you got to solve for each the asset class in question, and I think the way we've looked at it is the equity listed automation business is conceptually completely separate from OTC, right? I mean, it's you're on the listed side, you're kind of routing it to brokers and using things like broker wheels. On the OTC side, you've got to deal with the RFQ mechanics, which is completely different. There's a bit of overlap, for example, with the ETFs trading on venue, but we've kind of respected the differences and nuances of each asset class, but using like an underlying the actual technology is still the same. So what that allows us to do is potentially move certain features that we build for equities into the OTC space, and we've actually started to do that. So it's paying some dividends there. But you've got to treat them independently, otherwise you're just going to lose clients.
And I mean, Byron, Neptune was one of the first in terms of automation of axes and how that came together. How have you found that automation integration and data flows? And is that right in there, in the right point?
Yeah, I mean, automation to us is, I guess, twofold. One, I guess predominantly on the sell side, where ultimately automation's being used to take out the human element where the human doesn't add that much value. So in reality, what it's all about for us is getting real-time access out of the sell side and through to the buy side, and removing that staleness. I mentioned data quality before. I mean, staleness is one of a number of factors in that. So in that respect, using Fix, obviously, as we do at Neptune, has helped that significantly over the past few years. Likewise, one trend we've found on the buy side, whilst we integrate into an OMS or EMS vendors, what we've found is that the buy side are increasingly wanting to take the data through a direct API. And again, that's fantastic for those that have the resources to build their own tech and to feed that through to portfolio managers, quants, as well as the trading side of things. But that's certainly increasingly part of what we're seeing buy side doing on the automation side of things, and also using the data, even though it's axes and usually used for block trades, it's now being used as input into where electronic trade should be going as well in terms of dealer selection.
So it is about that bilateral connectivity, and it's about also just having those multiple streams and being able to provide that good quality data into the buy side and tailor to what they want to see. Yeah,
absolutely, being targeted, absolutely.
And I can just interject for a second there, Matt. It's interesting. In 2008-09, much similar to the COVID dislocation period that we've seen in both of those. Certainly at IHS Market, we've seen a massive increase in data demand. And so as much as you look at these as dislocations of normal sort of market functioning, if you will, they do tend to be quite sort of transformational. And post 0809, the industry didn't go backwards in terms of its demand for data. It just continued on. And I wonder, just picking up on Byron's point there, I wonder whether we will look back on this period in sort of another sort of 5 years time as another sort of watershed moment where the consumption of data, particularly from the buy side and the way that it consumes and distills it, we'll look back on this period as another sort of moment where that was enhanced and integrated in a sort of fairly substantial lockstep sort of way, or a large transformational sort of manner compared to the sort of status quo when markets are sort of more stable, if you will.
I completely agree with that, and I think, but the one question I got back to you then, Stephen, then is when we look at this as the industry, do we think we've got the right data quality there, the right ability to aggregate and pull this together to make it meaningful? If we have in the US, we have quite a strong sort of transparency regime there, and we'll get to the trace and the MiFID stuff in a minute. But as the overarching high-level question, do you think we've kind of got that, or and you guys have got around that conundrum, or do you think there's still work to be done?
I think that's exactly the challenge that we're grappling with today is trying to deliver greater insight from that data set and make sure that data set is as good as it can possibly be. It's not just a question of larger, it's a question of the quality of the data set as well. But in terms of mining data sets for insights, I think that journey is still very much in its infancy in terms of demand from the buy side, and you see that often in terms of the way that we see alternative investment managers interact with us and the sorts of insights that they're looking to distill from more traditional sort of long onlys. Their starting points are very different, but I think that there's an awful lot of scope for us to expand the way that we both aggregate and deliver those. So, we've got some exciting sort of developments from our data lake and from that we've announced and some other perspectives. But I think when you're thinking more generally about the industry, then that's the kind of day-to-day challenge, is how do you deliver it in a way that's easy to distill and easy to apply as well. I think that's something that
bringing Connie back in. So Connie, from your perspective, you've again, Liquidnet takes things from a slightly different way, but you've got this different liquidity offering versus what's happening in terms of the buy side to buy side, where it's generally a traditional principal market. Does that mean you've got a thirst for more knowledge of information and data when you're trying to put this picture together?
So I would say that without a question, more transparency helps with more electronic trading and more automation. Now, I don't think we're ever going to get to a state of the world of fixed income whereby we have equity-like transparency. That is not the intention. I also think that pre-trade transparency in fixed income will be led from commercial initiatives as opposed to regulatory mandates. And of course, the other big part here around pre-trade transparency is the way by which different firms, both buy side and sell side, efficiently gather and package the data that they already have, so that they become more actionable and more structured. That will help them obviously identify liquidity opportunities and also provide a pretty decent pre-trade picture for a particular instrument. So it might be the pre-trade. Now on the post-trade, Matt, as you know, I have very strong views about the need for the industry to have a proper consolidated tape. And whether this is something that resembles Trace in the US that has been up and running for many years, or let's say the European version of that. If we want this industry to continue to move forward and remain healthy, we have to have what I call a more modern regime a mandatory regime for post-trade transparency in fixed income. Data is important, right? And if you think about the way that liquidity information and data gathering has changed, it also creates a lot of opportunities, right? And you can have two asset managers that have the same strategy, the same size, let's say, and based on the different data sets that they have, whether it's pre-trade, post-trade, or more intelligent analytics, they can have a very different picture of the liquidity in the market. So I think as we go from less data to more data availability, this also creates this additional opportunities for differentiation and alpha generation.
Thanks, Connie. So I said I'd make this panel interactive, so we're going off script, throwing that away, get rid of the iPad. We've got a question in already. And in terms of what are we going to take from March? Trading protocols we have are sufficient, but need tweaking, question mark. New protocols are required. Low touch becomes high touch very quickly. Andy, you got any questions around that, sir?
On the low touch becomes high touch. I mean, I think it the term obviously sort of means different things to different people. You know, some term it in that way. You know, I think when we're looking at particular orders that are in our care, we look at it as we're driving that through one process, so like a one touch. Now, if that means that the trade is harder to transact than something that's smaller, then there'll be less time, obviously, that's needed on it. But the same trader is driving the execution and the strategy. Learning lessons, absolutely. You know, we've been doing a lot of work in and around, obviously, how we held up. Did things go according to plan? Are there processes that can be refined? Are there ways to basically sort of make the process more effective? Our volumes obviously sort of went from up in the region of sort of 3 to 4 times, through that period. So for us, obviously, we wanted to test to see whether or not there were areas that could be improved from a system standpoint. What we have found so far is that the team as a whole obviously used the processes and systems effectively. They were just incredibly stretched, and it's really a testament to the team that I've got that it held together so well, right? Because each person had to go above and beyond. So I think we're always looking to make refinements. It's some part of really the role of an active buy side firm that sort of does invest within its trading team. I think that the areas I think Stephen touched upon, sort of the sort of 07 to 09 crunch. Thinking back to those periods, it was harder to trade derivatives, things like iTrax and CDX. This time around, it was much easier due to clearing. The changes that have come through due to regulatory shift, transactions that we were recording voice and then processing through a venue. Again, things have improved over the years, and we benefited from some of those investments that we made in connecting to venues and being able to trade clear products. But we will continue to look to evolve.
Cool, thanks a lot. So got the results from the poll we had. It was a few minutes ago now, but it's in terms of, do you plan to increase your automation in the fixed income desk over the next 12 months? We've got 46% saying yes a lot, some saying 46%, and 7% are saying no. It's quite an interesting sort of split there. We've used the term now, I think 3 times I've counted. As people that know me, I have a number of soapboxes and bugbears. But when we're in fixed income land, we talk about electronic trading as basically being on venue. Do we need to redefine this? To me, electronic trading is basically processing a trade electronically. It shouldn't just be about trading on venue. But anyone want to respond on that one?
Yeah, why don't I jump in, Matt? Yeah, I think probably increasingly, I think that the term and to be transparent, we're sort of obviously working with both the dealers on Neptune and the buy side to look at ways that they can leverage the existing connectivity around Neptune for I guess bilateral or direct engagements as well in this space, which and again Neptune's not looking, nor would it look to become a trading venue per se, more a conduit. So I think as things progress, as we've seen in the FX markets, there will be, I think, quite soon, and there seems to be a lot of momentum behind this, particularly in the US, that you'll find that increasingly there might be whether you want to call it electronic or digitized execution happening bilaterally, particularly in bigger sizes, and I don't think it's necessarily going to creep into what we see with the traditional or established trading venues at the moment, but certainly in larger sizes, perhaps in the more liquid products that are, where the size is something north of what you would normally do in a competitive environment, then that's something that's coming, and a number of different firms are working on that.
Are there any contra views on that, or anything else you want to put out there? Or?
It's Konstantinos. I would say I think there's a difference in my view between electronic trading and automation, right? And I think the simple operating process, let's say, for taking a trade that was already executed and putting it in a venue or putting it into systems, in my view, and probably in the eyes of most of our customers, doesn't count as electronic trading. It is electronic processing. It is part of the automation development and evolution that we're talking about. So it is an important part of what's going to happen going forward. But personally, I think we should distinguish electronic trading, which revolves around liquidity formation, versus electronic processing, which liquidity and execution has pretty much taken place, and now we're just transmitting the fixed messages.
Cool, thanks, Connie.
Yeah, I might jump in there if I can, Matt. Just picking up on Connie's point, you do get the sense that venues, in the traditional way that we think of them, reflect a slightly outdated sort of paradigm now. And the most important thing is being integrated and being open to multiple sorts of integrations with providers or vendors that perhaps you might have looked at as competitors in the past. There does seem to be an industry shift towards everything being much more interoperable, and it's more about environments as opposed to this sort of strict sort of walled concept of a venue sort of per se. And some of that is going to be tools, and some of that is going to be things to optimize, and some of that's going to be things to automate, and some of that's going to be data sets to help you all do that, as well as being integratable with all of your other sort of system architecture, if you will. That makes sense.
Well, let's face it, for most fixed income, the majority of fixed income, it's not just executed in the club like in equities. It's a much more nuanced process. So while you guys were talking, because I'm slightly devious in this way, I launched the other side question coming up as well, which I think is an important one in terms of, what do we need to improve and enhance the secondary market in what's going on? And it kind of going into our next sort of question, which I think is a very nuanced answer, but do we just need to increase transparency? Put it out there. There's a lot of debate around this in terms of MiFID versus Trace, and what's happening. Do we just increase transparency and that's going to increase automation? Is that our answer? Andy, I'll go to yourself first.
Increasing transparency doesn't just bring about liquidity. So, effectively, yes, we can all see where things would then trade. And I think transparency is of very much importance to everyone, particularly when you're looking at the valuation process for an active manager or for an ETF in relation to that. It comes down to obviously sort of how the market needs to function. So it should lead to more liquidity potentially coming through, but it doesn't just create. It isn't sort of like a wave a magic wand and all of a sudden everything's just liquid. We have a number of instruments in fixed income which obviously sort of then make it much more dispersed. So not all bonds are as liquid as each other.
And it's about, it's about winner's curse. It's about that process of what's happening and that provision of the balance sheet and the relationship.
Mm-hmm.
Is there a contra view there? I know that it's quite traditional, or do we agree on that as a view? That's fine then. I've got questions coming in, but the people that are submitting them, I've got an order and I will come to you. But if you do have questions, please chuck them into Slido because I will deal with them, I promise. So when we look at that question that came out, interestingly enough, it's like, what will you improve, enhance secondary market trading most? Data quality. It's great that we're at a fixed conference, right? So moving on. So we looked through that. there's been, I mean, from my perspective, being a fixed income market structure guy, it's really exciting at the moment, right? We're seeing some real dramatic market structure changes. I think we're seeing good and bad coming out. What's the good, bad, and the ugly? Ravi, do you start with yourself, sir?
I think we're moving in the right direction in terms of more transparency, right? I think most people will say there's definitely more to be done there. I think there's a lot more that can be done with the data that's available. And I think there's obviously data that's available externally, and then also within each venue has data that they've got as well that they could potentially use to actually help clients to get more insight. I mean, you talked about how would you increase more automation. I think the low-hanging fruit's already been taken out, right? I think people now are trying to figure out, well, how do I increase my automation rates? And really, to do that, it's then kind of really getting into the data, or specifically the analytics that you can generate from that data. So we talked about yesterday things like TCA, right? I mean, that's been something which came out in relatively new green in fixed income with MiFID, and as you said, they got tick box exercise to some extent to have a system in place, and now people are questioning like, well, what other value can I get out of my TCA system, right? How can I actually get that to drive decisions in a pre-trade capacity? So we're kind of seeing more conversations around that.
Yep, that is definitely a soapbox for myself, and I completely agree. But I think one of the challenges we've seen when we're looking at TCA systems is defining the investment process, looking, just dragging and dropping equities in and saying, oh, okay, I've got an impact strategy. Well, when do I start the time frame? If I'm a European desk and I'm trading a US Treasury, do I start it at 9 a.m. GMT or 9 a.m. European time? No, the liquidity's not there. There's no point. So how do we actually do that? But you are going to be trading US Treasuries, or if you're looking to hedge bunds, what are you trying to do? Any other views around sort of the good, bad, and the ugly? Don't want to just be negative. I want to see the positives as well. What have we seen?
So I would say on the positive side, more different ways for asset managers and sell-side firms to execute, better quality of data on the pre-trade, especially with commercial solutions. On the negative, and potentially better pricing, by the way, as a result, a better execution achieved. On the negative side, I would say technological fragmentation. As we see more automation, we see more systems, more platforms. Suddenly, we see traders having to use like 5 different front ends, right? That's unsustainable. And I would say that as we think about, as an industry, how do we move forward? I think I want to go back to what Stephen said, that connectivity and interoperability are key. And we have to start moving away from the walls and the boundaries and towards more open architecture solutions that can be accessed from different systems and different providers. So if we want to avoid technology becoming a burden, we have to embrace openness and interoperability.
Thanks, Connie.
Yeah, look, sorry, Matt.
No, go on, Brian.
No, I was just to say, I would echo that. I think that open infrastructure, I think one of the probably good, bad, and ugly aspects is cost anyway, and actually getting, so that the buy side can get the most out of it and integrate in the easiest possible way. There remain incumbent systems which are difficult to integrate with, regardless of client pushes. And I think, ultimately, when it comes down to it, the best way to do that is to start pulling all this information together, and cost is going to be an enormous factor. To Stephen's point before, the pandemic's going to be, we've been cost conscious since the financial crisis, and it's, this is another leg towards that.
Right, so we've got the question in, and I've got flashing lights in front of me in the studio about needing to wrap up. So we've got 2 minutes. So I said I would address this question. It's been submitted anonymously, but we'll see. And I think this is an important one because we've been talking about the eco-structure, the systems. It's not just a trading venue. It's much more grayer. So when we look at this question, how do the panel think regulators react to more bilateral execution over unregulated systems when they have been pushing for an on-venue trading for years? Question which firm that platform might come from, but Byron, I'm gonna question you because
Yeah, I knew you would.
There is this big debate going on, and I'm going to go back to Andy because I want him as the end investor to see what he thinks should be the right thing to do.
Yeah, look, just very quickly, I think most firms that are looking at this is more in an infrastructure sense. So it's one institutional client and one institution trading with each other. The fact that might happen through a fixed connection or otherwise, as opposed to being a multi-dealer structured venue. I think certainly. Yeah, I think the regulators would be quite comfortable with that. I don't think there's any people looking to hide anything. It's just digitizing what's done OTC. If anything, it'll probably make it more transparent.
I just wonder whether it's a function of. I was just going to say, Matt. I just wonder whether it's a function of resourcing and justification that you build around that methodology or that approach. And as long as it's robust, I think that's what regulators are looking for in most instances, is a robust, logically sort of laid out methodology. If that's the case, then I think that's fine. It is interesting that you do tend to see a bifurcation between the haves and have-nots in terms of resources for those approaches.
And Andy, final comment to you, sir.
Yeah, I mean, I think Stephen's point is very, very, very fair. It can become the larger asset managers, that are able to basically sort of put the pipe work in, will get the benefit. From a regulatory standpoint, again, I think probably one maybe to ask towards the regulator, but it is basically sort of just executing a trade electronically between one organisation and another. It's the evidencing and the supporting information that goes with it. So if you think about whether it's TCA or execution analysis, however you want to frame it, it really is paint the picture around the trade at the time of the execution. What feeds can you bring in to support the executed price with the bank that you've executed with, and that, I think, is the key part. To actually show that this was the right trade to have done at that moment in time. Where you've got a number of other price points, potentially other inventories being shown, almost having a curve behind the trade that you've done. So I think if you can, when you're considering, just looking at the price of the trade, I think you do need the supporting evidence to go with it.
Thanks, Andy. And I've got all kinds of flashing lights going in front of me, and we have overrun, and we didn't cover all the stuff we want to do. But I think the critical thing we've got from this is that data is critical to automation. It's critical to a trading process to make sure we've got that there. So it needs to be thank the panelists for a great panel. I think we covered a load of content, and the fact that we ran out of time means that we've got so much more to do. So we'll have a quick break, and then we're getting into the delights of the equities consolidated tape and trying to untangle it. So please come back, and hope to see you soon. Thank you very much indeed.